George, thank you very much. And good evening. What a good-looking group. I'm nervous. I'm also honored. Thank you. Thank you very, very much. Very, very briefly, the firm, Brandis Investment Partners. We have a little under $30 billion under management right now. We manage only primarily equities under the principles put forth by Benjamin Graham. I started the firm 41 years ago after having met Benjamin Graham. We have a very nice office in Toronto. We have another one in Dublin. We have an office, a very small office in Singapore. And our headquarters is in San Diego, California. That's because I like warm weather. We have about 350 employees at the present time. So what I'd like to do, first of all, is tell you a little bit of how I got started and how I met Benjamin Graham. Benjamin Graham, the father of value investing, the dean of security analysis. And I was working on the sell side in San Diego, still like the warm weather, 45 years ago. And one day in the office that I was working in, Ben Graham walked in. And so I got to know him. This was in the early 1970s. And after having gone through, from the stock market standpoint, a very crazy, wild bull market in 1968 when I got started, to a very bad bear market in 1969 and 1970. I had both of those early in my career, those experiences. And then I didn't know what I was doing. I had no real investment philosophy. I had known a little bit about Ben Graham and his history and his philosophy, but it didn't really mean a whole lot to me because I had no experience. Now, all of a sudden, within a 2 or 3 year period, I had a lot of experience. And it wasn't all that fun, but I had a lot of experience. Then I met Ben Graham. And immediately, talking to Ben and looking at his track record, I decided that this was the way to go in investing. So at that point, I was a Graham and daughter. The basic fundamentals, by the way, of what Ben Graham taught me, if you want to really keep it simple, and he said, the important thing, one of the important things is to keep investing simple, because it's simple, but it's very difficult both. But the two basic principles are to be a really true, outstanding long-term investor. There's only two of them. The first one is be fundamental. Understand where new wealth in the world comes from. Understand that businesses and the fundamentals of businesses is where you want to invest. Okay, that's all you should be concerned about. And not all the fancy stuff that Wall Street and Bay Street comes up with year after year after year. Number two, if you want to do better than everybody else, if you want to be successful, if you want to be an outstanding investor, you obviously can't think like everybody else is thinking. You obviously can't be part of the crowd. If you're part of the crowd, you're not going to outperform the crowd. What is so great about basic value investing is that you can be separate from the crowd if you can think in those terms, and you can also be right over the, you can have both of that. And so that's what's so good and outstanding about value investing. That's why I adopted it right away after having known Benjamin Graham. And that's why in the 1974 bear market, by the way, things are not all that different. 2008, 2009 wasn't all that different. I went through 1974. The stock market, if you measure it on the S&P 500, was down 47.5% top to bottom. Those types of declines every once in a while do happen, and it wasn't just 2008, 2009 that was bad. And a lot of companies were going bankrupt in those days. And some of the other problems are different each time. But this same problems result in the same thing. One of the big problems then, of course, was the price of oil, believe it or not, going up considerably and not down. The other problem then was inflation. So that's a little background on my meeting and knowing the namesake of the school. What I'd like to do first is show you a video from the 1950s. I don't know exactly what year it was. This is the dean teaching in his class at Columbia University. Listen to this. This is Ben Graham.
The explanation cannot be found in any mathematics, but it has to be found in investor psychology. You can have an extraordinary difference in the price level merely because not only speculators, but investors themselves are looking at the situation through rose-colored glasses rather than dark blue glasses. It may well be true that the underlying psychology of the American people has not changed so much, and that what the American people have been waiting for many years has been an excuse for going back to the speculative attitudes which used to characterize them from time to time. If history counts for anything, that the stock market is much more likely than not to advance to a point where of real danger.
So, that's Ben Graham himself teaching. There is a vicious rumor going around that I was actually in that class in the 1950s. And I would tell you, I'm not that old. So what I'd like to cover this evening, a few points. I want to talk a little bit about what I call the Brandeis DNA, the basic fundamentals of the firm. I want to talk to you about our process of what we do and how we do things from a standpoint of three different things. We do the analysis, we do the valuation of companies, and then we do the construction of portfolios. And I'll talk a little bit about that. Then I want to go into what investment is not. There is a large confusion about what is true investing in the world today. And I find it from a lot of the bigger institutional accounts that we deal with. And we deal with some pension plans and endowment funds and things like big institutional accounts beside individuals. Matter of fact, most of our money under management comes from the institutions. And I tell you, these people are confused today. Even though they have billions of dollars to invest, these people are also confused. So the Brandeis DNA. I'm using the double helix here to tell you a little bit about Brandeis. I happen to have been on the board of the Salk Institute for Biological Studies, Jonas Salk's. It's based in La Jolla, California, one of the top schools in biotech research. And Sir Francis Crick was at the Salk Institute. Watson and Crick, the founders of the figuring out the structure of DNA. And Francis Crick, I had met him a couple of times because I was on the board there, and he was at the Salk Institute. So that's why I'm using the DNA. Here's the way we're structured. We are obviously very much, philosophy is the value philosophy. The other part is our process of which I will talk about in a minute, and our patience of being a basic long-term investor. The other part of our DNA is the fact that we've been around for 41 years, and we have a thought of the firm, our vision for the firm is the next 100 years. That's how we think in terms of it. We think that you have to be able to be independent because you have to think differently from the crowd. And so our firm is independently owned only by the people that work at the firm, because that goes hand in hand with the type of decisions we need to make in our portfolios. So how Brandeis works, the first part of it is analysis and our investment team process. That part is that our investment research team are divided into 7 different teams. And these teams, usually 3 or 4 people, senior research people on a team. These teams are divided into industry specialists. Not geographic specialists, but industry specialists, because we like to look around the world and have the whole world as our potential opportunity for investment. Not just North America, not just the US, not just Canada. If we have a bank analyst team, which we do, the financials team, they look at banks, so they look at insurance companies, basically, and other types of financial companies. They will look around the world for opportunities to invest in that particular area. And they will be specialists. They're supposed to have the knowledge of the real, true economics of the industry that they work in. So their job is to look around, screen for potential investments in their particular industry. This shows, again, our worldwide outlook, and some of our senior analysts and some of the countries that our senior analysts are originally from. They have a good worldwide perspective, as you can see. These people do a lot of really basic company by company fundamental research. Matter of fact, last year, going around the world looking at, our research teams traveled about 385,000 miles. I don't know who came up with that figure. I didn't, but that's the figure that we're using. On basic analysis of companies, first of all, we look around the world to try to find what we think might be the cheapest companies compared to their basic long-term intrinsic value. And some of the things that we are looking at when we start to look at a company, and these are just some of the things, you got to look at all the basic fundamentals of the company. But one thing, we look at balance sheets, we look at their leverage, we look at their debt, we look at their profitability and their profit margins and their operating margins. We look at their free cash flow contributions, either presently or how those free cash flows would be developed in the future. We look at their currency risk and currency mismatch and their commodities exposure, this sort of thing. And we look at their shareholder structure, and we look at their attitude towards shareholders over the long period of time. Those are just some of the things that our analysts have to really get a good handle on for these various companies that we're looking at around the world. Screening then is how do we come up, how do we find these companies? Originally, we're really different. Companies are different between, their economics are different between what industry they're in, whether they're a utility or whether they're an oil and gas or whether they're a bank or whether they commodities and materials company, that sort of thing. So our screening, trying to find these companies changes depending upon what industry we're looking at. I've used here an example of utilities. If we're looking at utilities around the world, which of course are regulated entities, we first of all start to look at price to earnings and price to book and price to tangible book and try to find where are the cheapest ones in around the world. And then we have to look at their actual enterprise value in relationship to the regulatory environment that they operate in and that sort of thing. So that is some of the basic type of screening we'll do in utilities. And for other industries, our screening will be different. Obviously, in technology, you're not going to screen on book value like you do with a utility company. Because in technology companies, book value doesn't mean a whole lot, and generally doesn't mean anything, actually. Some of the country attributes that we look at is this industry or is this company sustainable over a long period of time? Or is there something major happening in the industry that will change the economics of the past that have been true of this company over a long period of time? And of course, technology is an area where that really comes home to roost as far as changes in the economics of the business over a long period of time. If we're looking at a company, a lot of times we're looking at a company because it's not doing well. If a company is doing extremely well, for a value investor, generally the price is also going to be extremely well. It's going to be too high. So a lot of the times we're looking at an industry, we're looking at a company that might not be doing well right away. Well, we've got to determine whether that is a permanent or whether that is an opportunity because it's a cyclical change around. Now, most of the time, in my experience over the last 45 years of looking at this stuff, the changes that are permanently and permanent problems for the company that never requires and they don't come back is a lot smaller than actual recoveries over a long period of time. And so we have to consider that, though, when we're looking at companies. So once the analysts are done and they've come up with companies that they think from their screening is worthwhile to take a good hard look at the company itself, they will do a research report, an internal research report, covering all the attributes that they think should be covered and trying to come up with what we think that company is really worth over a long period of time. Not what the stock market put a valuation on it, because the stock market, by the way, is mostly wrong in valuating companies. Maybe not wrong on the short term sometimes, but they're mostly wrong on the long term. And I think you might have heard something different from that in the academic circles, but you won't hear it. You won't hear something different from that from George, I'll tell you. But in any case, what we need to do then, what the analysts need to do is they take this research report to the investment committee. Now, we have 7 investment committees. They look at big cap stocks, they look at US stocks, they look at mid cap stocks, they look at small cap stocks. Different committees do that. And we have a different committee that looks at emerging market companies. We have, within those committees, they're also looking at other products that we provide to clients if they need it, more specialized products such as Japan only, or Asia ex-Japan, or Europe only. And we have a committee that only looks at emerging market companies. So that's the nature of the investment committees. Before I get into selling, the investment committee's first responsibility is to, as a group, as a team, with all their different experiences, to come up with a valuation of what we think that company is really worth. what it is really worth fundamentally, economically, to the owner of that company over a long period of time. Notice that has nothing to do with the stock market, nothing. It has to do with the fundamentals of the businesses. What Ben Graham taught originally. You have to look, the only thing you look at is fundamentals. And so the investment committee then will make a determination of what they think that company's value really is. And we will put that value on. Then, after they do that, it is time to build a portfolio. And we try to build a portfolio of restricted number of companies in the name because we don't want to be so well diversified that we are so close to the index that we're not giving our clients a good value because they can just buy the index, of course. So why should we be close to the index and try to get fees from clients when they can do it a lot easier just by being close to the index? So we will have anywhere from 40 to 72 companies in various industries in various parts around the world into the portfolios. And the way we build those portfolios, we take the group of companies that are properly diversified in the portfolio and take the ones that are stock price is the cheapest compared to their basic long-term intrinsic value. We will sell those companies out of the portfolio when they get to our predetermined intrinsic value. They trade at a discount. Ben Graham used to talk about a third discount from intrinsic value. And we still kind of trying to find, if we can find it, a 1/3 discount before we would buy a company. When that company price goes up to our intrinsic value, then it's time to look for another bargain somewhere else. And so that's our sell discipline. It's kind of built in. And so you don't have to guess from the standpoint of where the stock market price is going to go to how you would sell it. You have it predetermined that here's what the company is really worth over a long period of time, and if it's selling at that, we're going to sell the stock in the stock market because we want to find something that is trading at a bargain. So this is just an illustration of the very simple margin of safety concept. The intrinsic value, and when we try to buy it at below intrinsic value, and then when we do that, we will hold on for quite some time. It takes some time for these things to be realized. At least a minimum, our outlook is a minimum of 3 to 5 years. Some people have said that have been somewhat successful. A guy by the name of Warren Buffett said, well, your outlook in owning a company in the public markets should be at least 10 years. And I really think that's actually true. So the margin of safety concept, when we're building a portfolio, we only want to have companies in the portfolio with a high margin of safety or a big discount. And as I mentioned, we try to be concentrated in our portfolios because we want to outperform the indexes. And the more names you get, obviously, the closer you get to the index, and then we're not doing our clients any favor. The other thing when we build a portfolio, clients have certain restrictions on us that they tell us. For instance, the very simple ones are, I don't want any tobacco companies in the portfolio. Okay, we will not ever do that, even if we think their valuations and things like that. Clients, and the big institutional clients especially, have all sorts of potential restrictions that we have to follow. But if a client comes to us and it gives us restrictions that doesn't give us the opportunity, we feel, to really put our philosophy to work, then we won't take that client. They'll have to go somewhere else. Trading is an important part too. After the investment committee has put together a portfolio, and we are necessary then to go around the world and try to find, be able to buy the public stock in that company, whether we go to the exchange in Milan, or whether we go to the exchange in the US, or whether we go to the exchange in Brazil or something like that. So we have a it's actually 24/7 trading department that concentrates on trying to get the best deal for our clients over a long period of time. Now, there is a problem with the money management. The bigger you get, the more problem you can have in the flexibility of being able to build a portfolio, and the more problem you have in the flexibility of being able to take positions in companies around the world or sell companies around the world without affecting the stock price negatively for your clients. So our trading department, what they do is very, very important to make sure that we don't do that. At a certain point in time, a money manager such as us can get too big and have too much money under management, and won't be able to be concentrated in their portfolios and become much more closer to the index, or be restricted to only buying the big companies, the large cap companies and that sort of thing. We don't want to do that. So in the past, we have closed down and won't take new accounts and won't take additions. Right now, we're finding enough opportunities to invest properly with $30 billion under management that we can still think we can invest properly. But in our small cap portfolios, we're getting to the point where we can't have too much money, because and we'll probably have to be closing that fairly soon and not take any new money. The same thing in our emerging market portfolio. But interesting thing about our trading, we found in our trading a few years ago that there was something really strange going on when we would go to the exchanges, and we would go to what are called black pools, and there would be bids out there and asks out there, and we would go in to take advantage of that particular ask, and all of a sudden it would disappear before we got our trade in. And we didn't know what was going on. Why would that disappear? Well, we were dealing with the Royal Bank of Canada in a lot of trading. And a gentleman at the Royal Bank of Canada talked to us about that, and we decided that in these black pools especially, something strange was going on. And it resulted in, I won't go into the whole story, but it resulted into a new black pool, a new exchange called IEX, put together by a gentleman from the Royal Bank of Canada, and we were one of the initial investors, and it resulted in a book by Michael Lewis called The Flash Boys. And so we were intimately involved in trying to correct that problem, and we are an owner of IEX, the new pooled trading platform that went to do away with the short-term speculators. So we had some fun doing that, and had some fun dealing with Michael Lewis. Anyway, after that, of course, we constantly monitor our portfolios. The analysts are responsible for keeping up with the companies that they originally brought to the investment committee, and we're always trying to maximize the margin of safety in our portfolios and changing them. But gradually, there's not a whole lot of trading. Trading has nothing to do with investing. Trading has a lot to do with speculation, however. And so but we do have to continue to monitor our portfolios. So that's our three-part investment process, the analysis, and then the evaluation of companies, and then the construction of portfolios. Now I'd like to take a few minutes to go into some of the things that I'm seeing right now in the investment world that I think is bad thinking. And especially on the institutional side. One of them is I'm so amused at when a big pension plan, and all these pension plans, by the way, have outside consultants to tell them how to run their investments, because most of the retirement plan people are not investment people, so they hire these consultants. And you see that, oh, they have talked about, we're going to invest now in hedge funds, or we're going to invest in alternatives, in pools, or something like that. Well, what does that mean? These are not investments. They are just structures of how you hold investments. And it's so amusing to me to hear this talk, that we have done all these studies, and we figured that we should put 5% of our assets in hedge funds. Well, that doesn't tell me a darn thing about how you're investing. Is this a long-short hedge fund? Is this a hedge fund that's hedging commodities? Or is this a hedge fund that's taking long-term speculative positions in the price of oil and gas? What are you really investing in? I don't think they know either, initially, these committees. So that goes on. But I'm going to talk about it a little bit later, that they have been very confused, and they still are, what investing really is, and what speculation really is, and what risk is. They don't really understand, really, what risk is. And from the standpoint of these big institutions, they do have to be, unfortunately, careful about short-term volatility. Price movements in stock markets. Price movements in stock markets on the short term are now, from many of the large institutions, their number one objective is keeping those price movements down. Now, those price movements on the short term are meaningless. Meaningless from a fundamental investor standpoint. But their number one objective is to reduce those, which I find just crazy today. This goes back to tremendous complications in the portfolio and the portfolio structures and how they feel that they should handle portfolios and things like that. And it goes something like this, keeps going back and forth in this school of fishes. And those back and forth movements, I'm sorry, I'm going to leave this up for a minute. It's going to make you a little sick, so don't look at it too strongly. But some of the things in the past that I've seen come through in the future, and these ideas keep going back and back and forth. One of them is you got a top-down forecast. You got to know what's going to happen in the future. You have to understand basic macroeconomics. That was true in the past. Now, when the fish going the other way, it's now macro hedge funds. You got to hire macro hedge funds because these guys are so smart. They know exactly what the fundamental economics of the future is going to bring, and you have to know that. Or portfolio insurance. In 1987, portfolio insurance was a big deal. That as your stock prices go down, you can be insured of, because you would be automatically sold out. You would be insured of no losses, or not the big losses. That was called portfolio insurance. Well, that ended in 1987, October 1987, when portfolio insurance cut in, and the stock market in one day was down 22%. So it didn't really protect them at all. Now the new thing is using derivatives to protect that downside. So it keeps going back and forth and back and forth. This one other thing I might mention, that back in 1979, after the decade of the 1970s, wasn't really good for equity prices. And so it was determined in 1979 that it was all over. You should not invest in equities anymore. And interest rates were very high, so you should go all your investing in bonds. 1982 started the biggest bull market in history for equities that lasted for 17 straight years. Now, I'm going to talk about this in a little bit. public equity stocks, investing in businesses is way out of favor. And a lot of the big institutions are saying we cannot invest in those entities that really create the new wealth in the world anymore because their short-term stock price volatility is too risky. And so that's happening all over again like it happened in 1979. So I'll get off the fish. Let me talk a little bit about risk. There's a lot of confusion about what real risk is and how do you measure risk. You know, one of the problems with the academic studies and the efficient modern portfolio theory is that they have to put a number, an actual number on risk. Well, how do you do that? Well, you define risk as volatility. So just about everything that they study is a basic assumption that volatility equals risk. So when you start off with a wrong basic assumption, your conclusions are also going to be wrong. And that's why their conclusions, ever since the beginning of modern portfolio theory, are wrong. Basically, because they're defining risk as volatility. The real risk is not stock market price volatility, but the real risk is the fundamental value of these businesses in what they can create in terms of value, not only for the shareholders, but value for their customers and value for their employees and that sort of thing. How they can produce what I call new wealth by adding to that value. And that really has nothing to do with the volatility over the short term of the stock prices for those various companies. So, but, as I mentioned before, the great majority of institutional investors are now, again, equating stock price volatility with risk, and they're reducing their risk by getting out of anything that has a volatility in pricing, or building their portfolios, very, very complicated portfolios, hopefully so that one asset in their portfolio would be going up when another's going down, so they can reduce that volatility of the valuations over a short period of time. And they are just absolutely concentrated on doing this. When you do that, over the long period of time, you're reducing your rates of return very considerably by doing that. This safe behavior enables them to avoid a lot of criticism about the valuation of the fund going up and down. And so they're all short-term oriented, and they sometimes the committee members on these big institutional portfolios are not around for more than 3 to 5 years, and so they don't really care about the long-term performance, but they do care about year-to-year performance, and it makes the fact that they are not going to be able to perform very well, and they have to because of the nature of what's going on. As an example, Ontario teachers, they've big pension plan, second biggest in Canada, or third biggest in Canada. They have 100 and, I forget their figure lately. I think it's about $150 billion in that plan to invest. The problem is that if they were to mitigate and not buy new wealth-producing companies, and they are very complicated in what they do. They've been doing some of it successfully, actually. However, they understand that they have teachers who retire at age 55, and a lot of them are ending up to be 100 years old. So they have 45 years of necessary growth for these retired teachers, and they are mitigating their returns by worrying about short-term volatility. This is kind of interesting statistic in Newfoundland and Labrador. There are 8,581 retired teachers. This was as of last year, I think. They are collecting pensions based upon 6,231 working teachers. Pensions are becoming a very, very big deal. This next slide is something I like to equate to the way investors are behaving these days and why they're behaving the way they are. This is soccer, one of my favorite sports. And this is a penalty kick. So I think all of you know the penalty kicks, and the 12 yards away, the kicker is 12 yards away. The goalkeeper has to stop this kick, but the net is 8 yards wide, so he can't really stop them, a penalty kick, very easily. So what do these goalkeepers do? They're good 94% of the time, and we know these statistics. They will either move left or they will move right. They will take a guess. And when they do that, they are successful in stopping the penalty kick about 25% of the time. Now, what happens if they do nothing? What happens if these goalkeepers stand right in the middle of the goal, don't guess right or left, take no action, they are right, they stop the penalty kick about 60% of the time is the fundamental. So why don't they stand there quietly doing nothing rather than standing right in the middle of the goal? Well, this is the same thing that these institutional investors' problems have too. They get severely criticized if they do nothing. They get severely criticized if they don't have the new thing of the moment in putting together a portfolio on their investments for the plan. They get severely criticized if they're thinking of dumb, if they just keep it very, very simple, do fundamentals and thinking different from other things. The same thing's true of the goalkeepers. If they just stand there and do nothing, they are severely criticized by the average soccer fan. They say, what the heck is he doing? He's not doing anything standing there. It's the same thing true in the investment world. If you think long-term, if you think fundamental only, if you don't have all the new things that are going on, if you don't think about alternatives, if you don't think about hedge funds, and if you don't take into effect all the new studies in the investment academic world and that sort of thing, then you are stupid and you shouldn't be standing there doing nothing. But if you are basic long-term fundamental and thinking differently from everybody else, if you're standing right in the middle, that's where the more success actually is. And it's very difficult to do, to stand right in the middle and do nothing. So some of the risk issues that I can talk about, and one of those is the complexity of the investment world and the continued complexity of doing all these things of alternatives and risk parity and macro hedge funds and all this sort of thing. This gentleman is the head of the Public Employees Pension Plan in Idaho. Bob Maynard is his name. And Bob is also on our study group called the Brandeis Institute. And he's been a client for a long time. And he's done a major study of big pension plans around the world. And the ones that become the most complicated in what they are doing are not improving rates of return over a very simple process that he uses in the pension plan in Idaho. And that is keep it fundamental, keep it long-term thinking, do some reallocation when things get expensive and try to get things that are cheap. He's done extremely well doing that. But as an institutional investor, He's not doing what the normal does. But his study is showing that if you do it that way, you perform better. And he at Idaho, they have 125,000 retired people that depend upon what that pension plan does. And he's been very successful in keeping it very simple and fundamental. He did this in a study called the Back to the Future, which he did for us at the Brandeis Institute. If you'd be interested in looking at it, it's on our website under the Brandeis Institute studies. Some of the things that are going on, which is normal from a behavioral standpoint, is herding, what I call herding, and you can relate herding to some of the passive things that are going on. There has been, especially since 2008, 2009, a very, very large movement in the institutional investors and for individual investors too, to so-called passive investing. We can't make decisions anymore. We're not good at making decisions about what companies to buy. And so all we're going to do is buy the index. Because the index grows after a period of time. And that has been a very big movement going on, especially over the last 7 or 8 years. If you look at some of the statistics of where new money is going into ETFs or into index funds, it has been a much larger amount of money that's going anywhere else in the investment world. And the way I think about this is it's a bad thing. Everybody says it's a good thing because institutional investors are not outperforming as a group, and they're paying their money managers as a group money that the money managers are not outperforming. So why would you hire anybody who wants to make an active decision about what companies to buy? You shouldn't do that. You should just buy passive. Here's what I see. And it's been a big move also around, on this slide I'm talking about de-equitization, but I'll talk about that in a minute. But this big move toward passive, you say, where does all this money come from? Where did Ontario Teachers' pension plan get their $150 billion from? Now, I shouldn't be criticizing them because these are good guys, actually, and they do think fundamentally and they do well. But I'm just using it as an example of these big pools of capital. Where did it come from originally? Well, it came from taxpayers, right? And where did the taxpayers get that money originally? It came from businesses that create goods and value that creates wealth, right? So they've got this pile of money that came from free enterprise wealth production. And they've decided they're not going to make any, by the way, Ontario Teachers doesn't do very much in the way of passive, they do some. They have decided that we can no longer depend upon the ability to pick good companies and to give them the capital that they need to grow and to take capital away from bad companies. No, we're going to go passive. Therefore, we make no distinction between good companies, bad companies. And when we go passive in the indexes, because the indexes are capitalization weighted, they're buying a lot more of the big companies than they're buying of the small companies. So it's been, I think that is not the way free enterprise economies and big pools of capital should operate, to go 100% passive and make no decisions whatsoever. If everybody did that, what would happen to free enterprise? What would happen to capitalism? There's no way of companies raising money because they are a better company than another one. So the talk that passive investing is a way to go, I have a big problem with that. Now, for some investors on a limited basis, passive investing, okay, that's fine, because they're not good enough to make decisions between companies. So that's fine. They should do some of that. But when you think about how much money has been going into just passive investing, I think that's a big problem. It's a lack of proper capital allocation that's going on right now. This guy B is beta. Beta is passive. Managers really that go totally passive are really abdicating their responsibility of making good decisions and giving capital to companies that are building wealth over the longer period of time. So this guy, Alpha, as far as I'm concerned, should be pushing Beta down the road. So before I take some questions, I think I do want to make some comments about where real wealth, real new wealth, real progress in the world comes from. And there has been, of course, if you look at history, obviously economic progress has happened. Maybe just over the last 200 years. But there's been a lot of great economic progress, and it will continue in the future, and it'll probably accelerate in the future because of the Ivy School teaching people the right thing to do, among other things. So sometimes we forget about where what I call new wealth comes from. One of the things that governments do not create jobs. They don't create new wealth, even though some politicians seem to think that they do. Financial engineering, this very fancy financial engineering, doesn't create new wealth. You know, the great majority of it is what we call zero-sum games. It's not creating anything new, but it's taking wealth away from one section and taking it and giving it to the same another section, but it's and reduction of volatility does that sort of thing. Whatever they use, it's a zero-sum game. And do we want to be involved? I tell you, I don't want to be involved in zero-sum games. I would rather be involved in investing where the real progress economically in the world comes from. And so bonds is another game that some people have said, well, you should only invest in bonds. Well, bonds don't create either. They don't create new wealth either, really. They enable companies to create new wealth, but they don't create new wealth on their own, so you don't want to invest everything you have in bonds. Now, there's a good reason, and I won't have time to go into all the reasons why you want to do bond investing. And Ben Graham, by the way, in the security analysis textbook, created chapter after chapter after chapter about bond investing and value bond investing also. So I'm not saying that that's not the place to go. But when you really think about it again, you get down to the fundamentals of where the new wealth in the world comes from, and you want to own businesses and give them the capital over a long period of time so that those businesses will create new value in the world by becoming more efficient and increasing technologies and that sort of thing. That's where the real wealth comes from. So thank you very much. That will be the extent of my formal presentation. Would you like to open it up for some questions?
So you mentioned earlier that the time horizon for how long you hold the investments is 3 to 5, and Mr. Buffett said somewhere near 10. But I've noticed there's a few companies he's decided to hold for much longer, like Coca-Cola or Washington Post. And so I was wondering if you could shed light on that strategy and if Brandis does that type of strategy as well.
Yes, Buffett has talked about getting into some of the very best companies that have moats around them, that they'll never lose their business because they are so protected from competition and that sort of things. And if you can buy these companies at a relatively good price, then to hold them forever is what he talks about. And he has held some of these companies forever. We feel that we're not necessarily good enough to know exactly what the next 40 or 50 years is going to result in. And we also feel that growth is never forever, even if you are Coca-Cola. And so we don't think in those terms. We think in terms of the changing nature of the economic world, and we think in terms of we try to think in terms of a minimum of 3 to 5 years, and that's how we operate. We don't think that when we're looking at the basic industry, the fundamentals, the history of how that happened, and what we think on somewhat of a guesswork what the future is going to bring, that we're going to be good enough to really be able to hold a company forever. Oh.
Hi, sir. So I have a question about what I believe is one of your largest positions. So the company's name is called Petrobras.
Petrobras, yeah.
Right.
Thanks for bringing that up. We're losing money right now.
Yeah. So you entered the position back in 2010, and unfortunately, or fortunately, perhaps the stock has been on decline, as you have just mentioned. But of course, like any value investor, you bought more of it if it's on sale, and you did.
Yeah.
But during that 4 years or so, have you ever doubted your initial thesis? Have you ever thought your analysts were wrong, or you yourself were wrong? And in addition, given the fact that Petrobras is trading for only a fraction of what you bought it at,
yeah.
Given the inherent volatility of the oil prices, do you think it has a future going forward?
Yeah. All right. Good. Fair enough. However, I don't want to hear any other questions like that. No. Yeah. Petrobras is the big integrated oil company based in Brazil, of course, and we bought it. At the time we bought it, we were considering the valuation of their reserves. We were considering that they were spending a tremendous amount of money in development of their reserves, and that they had the money and the cash flow to be able to do that at the time. And we thought, thinking in terms of 3 to 5 years, that it was going to take Petrobras, and offshore they had some of the biggest deposits in the world, and they have reserves which are expensive reserves offshore. But at the time we bought the company, it was one of the cheapest oil companies in the world because they didn't have free cash flow, because they were investing all of this money in developing those reserves. We also made an assumption at the time that, and we still have the same assumption, and we know we're wrong, but we think we can be somewhat in the range. We think that oil is really going to be the commodity price. You have to come up with some kind of an estimation. We know we're going to be wrong, but our estimation is that normally oil, in today, all the other factors we looked at, oil should be priced at about $70 a barrel. We felt at that price that Petrobras would not have any problem in developing their horrendously large reserves. At the price of $45 a barrel, it's too expensive offshore for Petrobras to develop those reserves. And the other thing, the other problem was, which we think actually is a short-term problem, and that is corruption within Petrobras. And there's some very bad news about corruption involving Petrobras, which we didn't know ahead of time in advance. So we're making an assumption, however, at today's price, which is about half the value of just their reserves that they have. For a long-term thinker, the corruption is going to be there forever. We're making an assumption that $70 a barrel would be a normalized type of, and so we are continuing to hold the stock, even though it's down by quite a bit, because we still think that the price is a considerable discount from a long-term intrinsic value of the company, even though this is one of the ways that everybody doesn't follow value investing and why it's difficult. Because we can get severe criticism for buying a company that goes down from the price that we buy. And a lot of times, we're saying it's a better value now. But the great majority of the thinking is that you were stupid. And maybe we were. But a lot of times when we buy companies and they go down in value and we buy more of them, it ends up that it works out very well for us. Thank you. I was kidding about the question. I like the question. Thank you.
Your group's known very well for investing globally, and some places that you're overweight include South Korea, Brazil, and Russia. Can you explain some of the factors that you look for when you invest globally?
Yeah, when as active investors rather than passive investors, we're always going to be overweight something. One of the statistics that is used is called active share. And active share is a study of how much different you are from the index. And our active shares we think has to be very, very high because if we're not giving clients what they're paying us a fee to do, and that is to make distinctions and to pick the value. So our active share, as an example, statistic of our global accounts is 91%, which means we're 91% different from the index. And to be really a good long-term investor, you have to have, in my opinion, a very high active share, or you might as well just buy the index. So we will be over-allocated to places based upon the fundamental value of the businesses that are located in those regions because a lot of companies' stock price is affected by the geographic region that they're located in for one reason or another. Obviously, Russia is a very obvious, risky geographic area. And so we would be over-allocated because of valuations in the country that are taking some companies that happen to be happen to be located in that country, but might have businesses that are quite a bit different from just the country location. And so that's one of the ways, as value investors, we can take advantage of the short-term stock prices. And right now, well, let me give you an example. About 3 or 4 years ago, Japan. It was considered, the standard thoughts about Japan was that it was a very, very bad place to invest. That Japan's stock market had not really gone anywhere. The economy had not really gone anywhere for about 15 years. And the Japanese miracle was over. And the Japanese population continued to get older and older. The Japanese sovereign debt was very, very high. And there had been a deflationary environment going on forever. Don't invest in Japan, anything. We looked at Japan and looked at the stock prices of some very, very good, high-quality companies that have to be based in Japan, but they do business around the world. Canon, Toyota, Sony used to be a good company. And a few of those, and we said, they are at 35-year price lows. The prices was the lowest we had seen in Japan since the 1960s. Nobody really wanted to invest in Japan for those reasons I gave you. So we were over-allocated, and we were over-allocated in Japan by quite a bit. And we got severely criticized. We actually got fired by some of our institutional clients because how could we be so stupid as to invest in Japan? Don't you know there's all these problems? And so it took quite a few years of being invested in Japan before we really started to make money big time. And what happened was the yen, which was overvalued, came down very, very considerably. And then everybody started to look at Japan. And the Abe administration in Japan started to do some right things as far as economics also. And at 2013, the Japanese market, when nobody was invested there, Japanese market was up about 70%. So we were over-allocated, so we did pretty well. However, because the yen came down so much in value, we didn't make 70% because the yen had declined against us as U.S. or Canadian investors by quite a bit. So we didn't make that, but we did do very, very well. So we will be over-allocated for various and sundry reasons in particular countries or particular regions of the world. Right now, we're over-allocated compared to the indexes in Europe. Everybody hates Europe right now. But there's some obviously very good companies based in Europe that are very cheaply priced because everybody hates Europe. Well, we don't care about Europe one way or another, but we do care about those companies that happen to have their headquarters there, and some of them are very cheap.
So, markets have changed a lot since the time of Mr. Graham, and most importantly, the way information is communicated to investors have changed a lot.
Yeah.
So I'm wondering if you think markets have become more efficient these days, and if so, do you think the number of companies that are trading below their intrinsic value has declined substantially?
Yeah, all right. The question is, have markets become more efficient because of the large amount of new information we get buried under daily? That's a very good question, and I don't know if I really have the great answer to that question. I think in some cases where there were companies undervalued because of lack of attention, lack of knowledge, and lack of really information, that the markets have become more efficient under that standard. What happened in Ben Graham's day when it was very difficult to find a lot of this information. I don't think there's any doubt that they've become more efficient that way. But on the other hand, I was undergraduate an economist. So, as you know, economists are two-handed. On the one hand or on the other hand. So I'm going to give you the economist's answer to your question. Nothing really has changed for human behavior tendencies. And that's not going to change. And human behavior tendencies are to think short-term. They are to think of being part of the group. To think about a few years ago that Japan was never, ever a place to invest. And that inefficiency is not changing and is not going to go away. And we still have that opportunities of that inefficiency all the time. So, what's the bottom line? Value investing still works.
What's your best and worst decision that you have to make during your 47 years of experience of investing?
The best and the worst. Well, Yeah. Obviously, the best decision was to adopt the basic principles of Graham and Doddism, and obviously to stick with it for the last 45 years. That was definitely the very best decision. The worst decision. Let me think. I think the worst decision, perhaps, was to not take into account this from the investment standpoint. I'm going to I'll stay away from the personal worst decision. I know my wife and family can give you a lot of those. I think the worst decisions had been at the points of very long-term bull markets to not try to do a little bit of market timing and to become a little more careful about companies that would be at the height of bull markets that would meet the value criterion and buying those companies because in a lot of times those companies were only the very poorest companies that would have the discount big enough for us to put into our portfolios. So I think the worst decision is to saying totally you can't market time and there's no point in ever doing that. I think some of that decision, and Ben Graham taught about this. He said sometimes you need to back off, and in big bull markets, be very, very careful about your investing. His advice, by the way, to individuals in Security Analysis and Intelligent Investor book was you should, when stocks are very, very cheap, and he tried to make this simple because he wanted to make it so people could really understand how to, when stocks are very, very cheap, you should have 75% of your investment assets in equities and 25% in bonds. And then when he said when stocks are very expensive, you should change it to only 25% in stocks and 75% in bonds. Now, I wouldn't been able to do that for the majority of our clients because we're hired as a specialist manager in value equities. And these big pension plans, of course, will have 15, 20, 30, or 40 different money managers to do different things for them. And we're hired to be in equities. And so we couldn't go to cash or we can't go to bonds because we're a specialist manager. But if we wanted to be able to I don't know if this was a bad decision on my part to want to build a substantial business with a substantial amount of money under management. We could have gone to the, and we would have been much smaller, but we could have gone just for individual accounts, and we could have said, we won't take your account unless we can make a decision exactly where you're going to go and whether you're going to hold cash. And whether you're going to be in bonds and whether you're going to be in stocks and that sort of thing. You could do that, and if you want to do that, you have much more flexibility as an investment manager, but you're also not going to get the big amount of money under management because that is not the way the world really works. They will not turn over a $100 billion pension plan. It's not going to turn over to you and say you can do anything you want, so I didn't go that direction. I suppose in some ways going that direction would have given us more flexibility and more fun. It would also have perhaps given us more opportunity to fail, but it might. It also would have been fun. Now, what I did, I'm sorry to keep going on, but what we did a few years ago, and we're now offering it to our Canadian investors, we offered it to them 3 years ago as the first thing. We called it Global Opportunities Portfolio. And in the Global Opportunities Portfolio, we have flexibility. We're not strangled on what we can do or where we can invest. So we can invest anywhere in the world we want. We can invest in any size companies, in any industry. And we have that flexibility. We can also hold a little more cash. And that is a fun portfolio to manage. And it's been quite successful for us here in Canada. And so we're now going to open up that portfolio to other investors in the world and in the U.S. But as a major institutional investment manager, generally we're not hired and given that kind of flexibility.
My question is about IEX, which you mentioned earlier. So what was your reaction when Brad from RBC approached you? Had you had suspicions that might have been going on in the market beforehand? And what kind of conversations, I guess, did you have with the investment dealers that may have known about it that you were dealing with?
Yeah, we had been dealing with Brad and when he was at RBC. And so that's how we got the relationship starting. And we had been seeing some of this weird stuff going on in our trading ahead of time, but we didn't know what was going on. But we did know that when we went to RBC, and there was a bid or an ask out there, and we were talking to them about this and starting to learn what was going on, and we found that we didn't see this at RBC, so that's how we were doing a little bit more business with them. We do business, of course, around the world with a whole bunch of different trading firms, but that's how we got started. And then Brad came to our head of trading, and they started talking about what was going on and how that was going on, and he got a pretty good handle on it. And then he, with 4 or 5 other buy-side firms, not just us, we got together and formed IEX to make it more visible about what was going on. So that's how it happened, and we're still one of the investors in IEX. But that's not our job. Our job is not to be a trading platform, and our IEX is going to be going to become an actual exchange, and that'll be good for us as investors in it, but that is not the main thrust of what we do. We're doing investments for our, not for us, but for our clients. But that's how it came about.
On Rennes Institute, there's an article about value premiums on microcap companies. Just wondering if you generally look at companies in this space, and if you do, does your approach differ from looking at larger cap companies?
Yeah. We have too much money under management to make it worth our particular while to do microcap. However, there is a lot of value in microcaps. And so what we've done, we have a group from our company who had some 3 very smart people who had been doing work for us in the Brandeis Institute and doing a major study on microcaps. And we've been doing this for years and years with a group of professors from a university in San Diego. And what we have done is taking those 3 people, we have spun them off into a separate company that are using some algorithms to do a quant type of operation in the microcaps. We don't feel that we could afford to do the major analysis of all these small companies, and there's about 12,000 of them in the world. from the standpoint of how our company operates. So we spun them off, and they are using algorithms in the computer operation, and they will, on microcaps, they will buy somewhere between 200 and 300 companies, all value type orientation. And they've been doing this now for about 5 years internally with our money to see how it works, and some back testing. And it works very, very well. The outperformance has been about 500 basis points a year compared to the microcap indexes. And so they now have gone public to manage money for outsiders. And that's just happened. And they're going to manage it on that quantitative basis rather than the way we do it. So that's why we spun them off. But it's a very interesting world. I'm also on the board of a company started by a gentleman by the name of Michael Van Bema. And Michael Van Bema worked at Columbia University in the Graham and Dodd School there. And he came up with a idea that, especially in microcaps and in small caps, you've got to be very, very small money managers. And the advantage of smallness gives you that flexibility to be able to buy those smaller companies. So he formed a new company about 5 years ago, Van Bema Value Investors. And what he does is look around the world for talented, smart, Graham and Dodd value people that only have a few $100 million under management, period. And he puts them in together with a fund of funds. And they could be some U.S. investors, some Canadian, some from Europe, some from Singapore. They're all deep value people. And that's all he would put into his fund of funds. Long only, deep value people. So he's been doing this for about 5 years. His track record is not great, but it's been a bad 5 years for value, actually. But his track record is quite decent, and he has a global, and he has a U.S. only, and the global, he's been performing okay, but not really beating the microcap index, and then I do believe he's been beating the index in the U.S. only. So the microcap is a very interesting place to be if you're small enough.
So I was curious as to your perspective on short selling, because it seems like most value investors focus on investing in undervalued businesses, but why not go the other way? I mean, from a long-term fundamental perspective.
Yeah. Did you see George's talk? Yeah. Okay. To make a long story short about shorting, just a couple of things. There's an upside limit to shorting. It's 100%. But there's a downside, unlimited. And I don't really like those kind of odds when I'm doing investing. Because a lot of times the outperformance comes from companies that you have in your portfolio that don't go up by 100%. They're going to go up by 2 or 3 or 400%. Then you need those companies in a portfolio to be able to outperform. And shorting, you can never go over 100%.
Okay. I was wondering, when you're evaluating a company, how much do you take into account, for example, a company's plan, strategic changes, or any factors that you think might change the future dynamics of the market in relation to this company versus just how it's been performing historically? How much do you take into account, unknown factors?
You have to. You have to take that into account. Has to involve forecasting the future, which is very difficult, and that you're probably going to be wrong, but you do have to take it into consideration. We took into, quite a few years ago, we took into consideration that the newspaper business was going to be deteriorating because of internet advertising and whatever. You know, the newspaper business used to be, and Warren Buffett was bright enough, 30, 40 years ago to say, well, one of the best businesses there is, because they had a monopoly on advertising, basically in most of the cities that they were in. And boy, their rates of return were fantastic. That's why I bought the Washington Post in the first place. That was changing. The stock prices of newspaper businesses were decimated. And being value people, we were saying, okay, we made an estimation of how fast that would happen, and we said the stock prices are too low. Even though it is a declining industry, the stock prices are much too low, and so we bought them. Well, our forecast then was not very good because we gave them a longer period of time to continue to have some economic value than they actually did. And so we didn't do well in those companies at all. But so that's a pretty good prime example that you've got to think about these changes, and you've got to be, especially these days with the speeding up of technology, you've got to be making an estimate that perhaps needs to be much more conservative than we have been in the past about how fast these changes are going to be, because they're speeding up. Another change would be the film industry. Kodak, which went bankrupt. One of the premier Nifty 50 companies was Kodak in the film industry. We knew digital was coming along, and we actually didn't lose money. We actually bought Kodak and made money. But the estimates of the deterioration in the film business were way under what how fast the deterioration and how fast digital photography actually improved. I can remember, talking about, well, yeah, the digital guys are coming around, but they'll never have the quality that actual film has. That was the conventional wisdom. And I think I was probably thinking about that, and I didn't know because I was too stupid to know photography and how great the film was as compared to digital and how fast digital would go. So we didn't get caught in that one, but that was a major, major change. And so those things you have to be aware of.
There is one last question that I normally ask at the end, and this is, what is the most important thing you learned in life and investing over the last 45 years?
Yeah. The most important, and that's a tough question, John. I think the most important thing is to think for yourself, be independent, and don't always take everybody else's opinion, and think long term.